Hello guys, welcome to Bhamna's Online Academy. So in this video, we are going to learn all the illustrations of the chapter investment decisions, or what you call as capital budgeting. In the previous video, that is the part 1, I have explained all the concepts of this chapter. So please watch that before you start through this video. So it's very much helpful for you to understand and get the flow of this chapter. Yes. So now let's get into the video, guys. So illustration number 1. Yes. So here we are saying there is ABC Limited, and ABC Limited is evaluating the purchase of a new machinery. So ABC Limited is thinking, should I purchase a new machinery or not? The new machinery with a depreciable base of 1 lakh rupees. So the total depreciation of the new machinery will be how much? 1 lakh rupees. Okay, and the life of the new machine is 4 lakh, and the change in earnings before earnings before taxes and depreciation. Here what they are trying to say is, if you are going to purchase this new machinery, you will have a change in, that means from the old you will get a new EBIT, no? So here they are saying you will get a new earnings before taxes and depreciation. In first year you will get 45,000, in second year you will get 30,000, in third year you will get 25,000, and 35,000 in the fourth year. Assume straight line depreciation and a 20% tax rate. You are required to compute cash flows. You are required to compute cash flows. Now what concept will get hit here? The concept 1 that I thought, where I told you how you find out your net cash flows. In that I told you what you do for depreciation. What you do for, can someone tell me what do we do for depreciation? We first add the depreciation, we first reduce the depreciation as an expense before we calculate our cash flow, before we calculate our earnings after tax, so that the tax effect could be taken. And then at the end we add back our depreciation, and at the end we add back our depreciation to find out our net cash flows. Does everyone remember this? Why am I not getting any replies? I hope everybody remembers this. Okay, so here first take, let's see here, 1, 2, 3, 4 earnings before tax and depreciation they have given in the question itself. First, what you have to do, you have to reduce your depreciation. So less depreciation. So less depreciation, total amount only they have given, total amount of 1 lakh rupees. So every year, how much will be the depreciation? Anyone unmuted themselves? Please mute. Please mute. Okay, fine. Kindly make sure that you're not unmuting yourself. Okay. Yes. So 1 lakh rupees. So what is the, under straight line depreciation method, what is the formula of finding out depreciation per annum? You do original cost minus salvage value by divided by life. So here there is no salvage value. So directly 1 lakh divided by 4 years. So every year 25,000 will be your depreciation. So 25,000, 25,000, 25,000, 25,000. You find out the earnings before tax of 20,000, 5,000 and 10,000 here. Here it is 0. Then you reduce your tax, and after that you find out your earnings after tax. Okay, and after that what you have to do? You have to add back your depreciation. You have to add back your depreciation, because depreciation is a non-cash expense. And when you're finding out your cash inflows, when you're finding out your cash flows, you are not supposed to consider any non-cash expense. You're not supposed to consider any non-cash expense, because due to that there will be no movement in cash. So to nullify the effect, we are adding back the depreciation here, because we had reduced it before. So once you add back the depreciation, whatever value you get will be your net cash flows, Is illustration number 1 clear to you all? Can you get a thumbs up or a yes? Quick. Let's move on to the illustration number 2. Where is illustration number 2? 1 minute. Yes. So illustration number 2. So here they are telling that you have a project and you require an investment of 10 lakh rupees. That means your cash outflow will be 10 lakh rupees. It requires investment of 10 lakh rupees, and it yields profit after tax and depreciation. Profit after tax and depreciation, which is as follows. It is given here. Here 1, 2, 3, 4, 5, and the total of these 5 years is given here. Okay. Suppose further that at the end of 5th year, the plant and machinery of the project can be sold for 80,000. That means here you have a salvage value of 80,000 for the plant and machinery. You have to determine the average rate of return. What is the formula of average rate of return? Hope you all remember. Average rate of return formula is something divided by something on average. It has 2 formulas. Quick. Come on, fast. Average net profit after tax divided by average investment, or yep, you can do average net profit after tax divided by initial investment. By both the methods, you have to do and come only. If I'm not spelling your name wrong, it is Tirisha only. She has answered. Very good. Yes. So here what you do, average net profit after tax, average, how you do? You take all the 5 years net profit, you take and you divided it by 5 years. So the total of 5 years net profit after tax is 4,60,000. Total of 5 years profit divided by 5 years. So every year, how much do you get? 4,60,000 divided by 5. 92,000 will be your average NPAT. 92,000. Divided by, here you do initial investment. So in case of initial investment, what was our initial investment? Our initial investment was 10 lakh rupees. So divided by 10 lakh, if you do, here you will find out 1 ARR. Which is 9.2%. Here you have to do average investment. What was the formula of average investment that I taught you? Average investment formula is, come on. So to all of those people who don't remember what it is, I'll take you back to the formulas chart. And I hope at least by seeing that you remember we have read something like that. 1 minute. Discounted the internal. Yeah. Remember we read this. It was initial investment. It was initial investment minus salvage value divided by 2 plus salvage value plus working capital. Okay, so here you are not given working capital in the question. You are directly given initial investment of 10 lakh rupees minus salvage value of 80,000 rupees divided by 2 plus salvage value of 80,000 rupees. Now calculate and tell me how much that will be. 10 lakh minus 80,000 divided by 2 plus 80,000. So it will be 5,40,000. So it will be 5,40,000. Again, let's go here. So it will be how much? 5,40,000. So what will be the percentage here? 92,000 divided by 5,40,000. It will be 0. Please mute yourself. So it will be 0.17037 something. So it is nothing but 17.04%. Okay. So it means that you are getting an average rate of return. If you invest 10 lakh rupees, it will be 9.2%. Here, since you are taking average investment, we got to know that our average rate of return is 17.4%. Okay. So here, if you can see, we have solved by both the methods, 9.2%. 17.04%. Okay. So solve by both the methods and come in your examination. Okay. Illustration number 3. Compute the net present value of a project of a net investment of 1 lakh rupees. Cash inflow is 1 lakh rupees and the net cash flows is 55,000 for first year, 80,000 for second year, 15,000 in third year. And the cost of capital is 10%. So you have to find out NPV. This is very, very easy for you. Year 0, 1, 2, 3. Net cash outflow is 1 lakh. Inflow is 55,000, 80,000, 15,000. Find out the discounting factor at 10%. Write all the factors here. Multiply your net cash flows with the factors and find out your discounted cash flow, or we can say present values. And if you do a total of all these present values, you will get your NPV 27,340. Now here since the NPV is positive, you can accept the project. Any doubt in third illustration? Can I get a yes if you have all understood? Somebody has also asked, ma'am, have you sent the formula chart in Telegram? No, I have not sent the chart in Telegram because I thought after the whole of this today's class is completed, I'll consolidate everything in one PDF and send it to you. By today, I'll definitely put it into a PDF and send it. Okay? Yes. Okay. So I hope there were no doubts. Okay. Let's move on to illustration number 4. See, now once you understand the concepts, how quickly all the illustrations are running through. In 5 minutes, we have completed 3 illustrations already. Okay. So now let's move on to illustration number 4. So ABC is a small company that is currently analyzing capital expenditure proposals for the purchase of new purchase of equipment. So ABC Limited is thinking to purchase a new equipment. The company uses NPV technique to evaluate projects. So the company is going to use NPV technique to evaluate which project should it use. Okay, the capital budget or the total amount that it can spend is 5 lakh rupees. And ABC believes that this is the capital, maximum capital they can raise. That means they can only spend 5 lakh rupees. So the initial investment and the projected cash flows for each project are shown as below. The cost of capital is 12%. You are required to compute NPV. So in the question, they have given you two information. 5 lakh is your maximum capital budget and 12% is the COC. And the rest of the information is given here. Okay, project A, project B, project C, project D. So since here they are using net present value technique to evaluate the projects, you have to find out the NPV of each project and tell them with the project with the highest NPV is going to be the most beneficial project to them. Okay, so here you will calculate NPV. So here what you do, so first you take project A. Here you have find out the PV factor at 10%. They have found out the PV factor at 10% itself. Okay. So what they have basically done is project A, outflow 2 lakh, year 1, year 2, year 3, year 4, year 5. These are the cash inflows. Now these are cash inflows. You have to come and multiply here with the present value factors. If you multiply all of these with the present value factors, you will get a discounted cash inflow of 44,000, 39,000, 35,000 and 31,000. This will be your cash discounted cash inflows. Okay. The same way, and the outflow will be 2 lakh rupees. And by this year, 5th year, it's given here. And by this, you will find out your project A NPV as 19,750, 19,750. The same you have to do for everything. Project B, all the cash inflows which are there, you have to come and discount it at 10% and find out the cash inflows, discounted cash inflows, and then find out the NPV. The same once you do for all the 4 projects and you have found out all the NPVs, you will see which one is the best. Here the best NPV is 27,000. So project C is the project that you have to select. Any doubts in this, guys? Since I think I've gone a little quickly on this, I hope you all understood. We are doing nothing. You're just you are doing all the cash inflows, you're discounting it at 10%, which is your cost of capital. And then you are comparing your cash outflow and all the discounted cash inflows and finding out your NPV. And whichever was the highest NPV, you took that project to be the best and you will invest in that project. So I hope everybody has understood. Since I have not got any doubts anywhere, even a little doubt, how this point came, how this decimal came, or how this number came. Even if you have any doubts, you can ask me. Okay, stop and ask me. Don't hesitate. Okay, everybody, some other person will have the same doubt, but they'll think there are so many people in the class. This person, nobody is asking doubt. Then it will look like I am the dumb one and I am asking the doubt. It's not that case. Okay, everybody in the class has doubts. It's just that only few have the courage to ask them. So make sure at least you direct message me, like you put it in a DM and send me in case if you have any, a very little, a minor doubt also. Okay. So illustration number 5. So illustration number 5 says, suppose we have 3 projects involving discounted cash flows. Here they themselves have discounted the cash flows and given here. You need not discount. They are discounted and given you. That means these are the present values. That means these are the cash flows, cash inflow value as on today only. 5,50,000, 75,000 and 1 crore 20 and 100. I mean, yeah. So 1 crore 20,000 respectively. Suppose the further that the sum of discounted cash inflows. Sorry, this is cash outflows. I'm sorry. I read it as cash inflows. This is cash outflows. Here you have got discounted cash inflows. Discounted cash inflows are 6,50,000, 95,000, 1 crore 30,000. Okay, you have to find out the desirability factors. Desirability factor or profitability index. What was the formula? Present value of, yes. So this is the topic we are talking about right now. Present value of cash inflows divided by present value of cash outflows. In that question, present value they themselves and found out and given us. You need not find it out. Okay. Okay. So if you do this, 6,50,000 is your cash inflow divided by 5,50,000 is your cash outflow. You find out the PI factor of 1.18. The same you find out for all the 3 projects. Okay. And so here they are saying that if now we had studied that if it is more than 1, you can accept all of these projects. If it is more than 1, all of these projects are desirable and you can accept these factors. So somebody has asked, how do we calculate annuity factor? At the end of the class, I'll teach you how to do it. Okay, so I hope illustration number 5 is also clear to you all. Easy only. There was nothing in that. Illustration number 4. At A Limited has a project involving an outlay of 10 lakh rupees. This is your cash outflow, resulting in a cash inflow of 2,50,000 for 6 years. Assuming the salvage value is 0, determine the IRR for the project. Here you have to find out IRR. Okay. Okay. So here basically what we do is, we are discounting it at 12% and 13% and seeing what we get as present value. Here we will see what we are getting as NPV. At 12%, if you discount the cash inflows and find out your NPV, your NPV will be 27,750. How? It will be 10 lakh is your cash outflow, present value of cash outflow. This is your present value of cash inflow. Present value of cash inflow is nothing but cash flow into your present value annuity factor of 12%, comma, how much years? 6 years. Okay, 6 years. The same way they have taken the same thing for this also. Okay, the same thing they have done at 13% also. So here they have done PVCO, you know what is the present value of cash outflow. So to find out the present value of cash inflow, what they have done? They have done cash flow, which is 2,50,000 into present value annuity factor of 13%, comma, 6 years. 13%, comma, 6 years they have done, and they have got an annuity factor of 3.988, which is minus 500, So here first I'll explain you the concept, then we'll move on to how do we calculate PVAF. Okay. Yes. So then we have got a NPV of negative. So you have a positive NPV and you have a negative NPV here. So that means your NPV at 0 will lie between, the factor will lie between these both only. So what is the formula that you use here? IRR at 12% plus lower rate NPV divided by lower rate NPV minus higher rate NPV into rate difference. If you do, you get a IRR of 12.978%. You get a IRR of 12.978%. Okay, in the sum, do you have doubt? Leave the PVF. How this answer of 12.978 did you get? Do you have any doubt? We have did nothing. We have discounted all the cash inflows and brought it to the present value. And after doing that, we have found out the NPV at 2 different discounting rates. And using that NPV, we have found out the discounting rate at which our NPV is 0. And then that means our IRR is 12.978%. That means at this, our NPV is equal to 0. Anybody who has any doubts in this, who did not understand this, you can tell me, repeat if you did not understand this. Quick. Any doubts? Anybody who wants me to repeat this? Say at least you're clear means let me know that you're clear. Okay. If you choose 10% and 5%, IRR will be different. No, the IRR will not be different. The IRR will be the same only. Any IRR is a rate at which your NPV is 0. How can NPV be 0, 2 or 3 different rates? At one rate only your NPV will be 0. If you take 10% and 15% also, your NPV will be 0. I mean, if you take that gap also, you will get IRR same only. Okay. Yes. Oh, there is one person who has told me to repeat for the final time. I'm going to repeat this. Okay. If you don't understand, then after the class, you can come and ask me. So how do you find out NPV? PVCO, present value of cash outflow minus present value of cash inflow. Your present value of cash outflow was 10 lakh rupees. Your present value of cash inflow, you have to find out using the discounting factor. Okay. So we have taken, at first case, we have taken a discounting factor of 12%. If you have discounted at 12%, then your present value of cash inflows was, it was 2,10,000 into 4.111. Your present value of cash inflows was 102,750. Okay. Your present value of cash outflow was 10 lakh. If you discounted the cash inflows at 13%, you would have got a present value of cash inflow at 2,50,000 into 999,500 and 10 lakh would be your cash outflow. So now how do you find out NPV? NPV is nothing but your cash inflows minus your cash outflows, your cash present value of cash inflows minus present value of cash outflows. So the NPV in both these cases, here it would be minus 500 and here the NPV would come as 27,750. Okay, so now at 12%, your NPV is 27,750. At 13%, your NPV is 500. We need to find out such a rate at which your NPV is 0. So that rate will be called your IRR rate, where your NPV is 0. Okay, so now how do you find out IRR? We have read the formula. Using that formula, I found out the IRR, which is 12.978%. Pavi, is it clear to you? I think you are the one who told me to repeat it. Can you do it with 10 and 15%? We'll do it at the end of the class. Okay, let me go through. Okay, do you all have more 10 to 15 minutes to spend so we can go through rest of the questions? Using 10 and 15%, I'll solve it again. Okay, promise I'll solve it again, but let us just go through all the illustrations once and then spend time on that. Okay, can we move, or do you all have 10 to 15 minutes more to spare? We are almost at illustration 7. So, okay. Fine. Okay, now let's move on with illustration number 7. So here they are again telling you to calculate the internal rate of return. Here the investment is 1,36,000, which yields you the following cash inflows. So this is your cash outflow and these are your cash inflows. Here say again 4, 5. Here you have to again calculate your IRR only. Okay, here I think you will be able to understand better. This question, here it is better. Okay, mute yourself. Okay, good, fine. So here what we do, here we have to find out IRR. Again, you start with 10%. Okay, here again you start with 10%. So here 1, 2, 3, 4, 5 cash inflows are 30,000, 40,000, 60,000, 30,000, 20,000. You discount this cash inflows at 10% and you get a present value. And total present value of cash inflows is 1,38,280. Your initial investment is 1,36,000. So NPV is nothing but your cash inflow minus cash outflow. Present value of cash inflow minus present value of cash outflow. So you do 1,38,280 minus 1,36,000. So here you get an NPV of 2,280. So here at 10%, you have got a positive NPV of 2,280. Now they are taking a discounting factor of 12%. Next, you can also take a discounting factor of 15%. Still the answer will be same. Here they have taken a discounting factor of 12%. And when they discounted using 12%, they have got a present value of cash inflow of 1,31,810 and the present value of cash outflow was 1,36,000. So for NPV, you have to do present value of cash inflow minus present value of cash outflow. So when they did that, they got an NPV of minus 4190. So at 12%, they have got NPV of minus 4190. Okay, now they have to find out such rate at which your NPV is 0. Such rate at which NPV is 0. So if you use the IRR formula, you will find out the rate at which the NPV is 0. So that rate is 10.704%. That rate is 10.704%. Did you all understand this question? Was this question more understandable? Illustration number 8. So here the company proposes to install machine involving a cost of capital cost of 3,60,000. So 3,60,000 is your cash outflow. The machine life is 5 years and the salvage value at the end of the life is nil. Okay. The machine will produce net operating income after depreciation of 68,000 per annum. Okay. Here they have given you that the tax rate is 45,000 and they have given you discounting rate. At this is discounting rate. Cumulative factor means your PVAF. They have given you here. Okay. I'll tell you what PVAF is in simple terms. PVAF is nothing. See, if you're discounting, suppose let's take 10%. Okay. 10% if you're discounting it for 3 years, what will it be? It will be 0.909, 0.8. 1 divided by 1.1. Second year discounting rate will be 826. Third year discounting rate will be 751. Now, what does PVAF means? PVAF means if you discount 10% for 3 years, what will be your total of discounting rate? Your total of discounting rate would be 0.909 plus 0.826 plus 0.751, 2.486. So this is your PVAF of 10% at 3 years. PVAF of 10% at 3 years means nothing, but it is nothing that 10% if you discount it for 3 years, and if you add all these discounting factors, that will be known as your PVAF. That will be known as your PVAF. So PVAF 10% 3 years is 2.486. If you have to find out 10% for 10 years, then accordingly you have to add all the discounting factors. Okay. I hope you understood this, but there's a shortcut to find out this. What is that? I'll tell you later. Now, I hope you understood what PVAF. That means at 14% PVAF, this is at 14% for 5 years. This is at 15% for 5 years, the same way. Okay. Here the meeting is going to end in 1 minute. I'll close this meeting now and then you all can join back again. So in this question also, you have to find out your internal rate of return. In this question also, you have to find out your internal rate of return. Okay. But for that, we would need to find out what are our cash inflows, correct? In other all questions, cash inflow was directly given to you. So you would usually discount it and find out your IRR. But here, now the cash inflows is not given directly because they have told you that this net operating income is after depreciation. That means it is in this step. They have a profit. Why is this not writing? Okay. They have a profit. And from that, they have reduced the depreciation and they are standing at earnings before tax. So here, this is what they have given you in the question after depreciation. That means after reducing your depreciation, the profit is given. It is 68,000. So from that, you have to reduce your tax, which is 30,600. Tax rate is given in the question. Your profit after tax will be this. Then you have to, what you have to do? You have to again add back your depreciation. But now, how will you find out your depreciation? Is it given directly in the question? Is it given directly in the question? Can someone tell me? No, the answer, I mean, the question does not give it directly. So here they have assumed that since the salvage value is nil, what is the depreciation formula? Original cost minus salvage value by number of years. Original cost is 3,60,000 divided by number of years is 5 years. So per annum depreciation is 72,000. So here, since you are calculating cash inflows per annum, see here, this is also per annum only. See, per annum, 68,000. It is 68,000 per annum. So depreciation also per annum only you have to calculate. So 72,000 you will add back and you will get your cash inflow of 1,09,400. So this is your cash inflow per annum. Cash inflow per annum. Okay, 1,09,400. Okay. So the what they are saying here is that, yes. So here they have taken two discount rates, 15% and 16%. So the cumulative factor is 3.35% and 3.27%. Your present value of cash inflow, since here what they are telling is that for all the, so 5 years is a project life, no? How much years? 5 years. Okay. So here they are saying that 5 years, every year, 1 year, 2 year, 3 year, 4 year, 5. All the 5 years, you are getting 1,09,400, 1,09,400, 1,09,400, 1,09,400, 1,09,400. All the 5 years, you are getting the same cash inflow only, as we found out here. So here, when what you usually will do, you will discount it at, if you are taking a rate of 15%, you will do discounting factor at 15% and you will write all the discounting factors and then you will find out your present value. But here, rather than doing that, what they are given is, they are given a total of all these present value factors. They have given you directly PVAF, present value annuity factor of 15 years and 5 years. They have directly given you in the question. What is the present value annuity factor 15 years of 5 years, 15% 5 years? It is 3.35. That means for 5 years, the discounting factors, if you add, it will come to 3.35. So this total here is, so the total of this is 3.35. So here what we are directly doing is, we are directly doing 1,09,400 into 3, since this all is the same, we are doing 1,09,400. Rather than doing it individually, 111, you are doing it directly with the total. So it will be 3.35% and you find out your present value. What is your present value in such case? 1,09,400 into 3.35. Your present value is 3,66,490. The same for 16%. You are doing 1,09,400 into a total present annual annuity factor 3.27. Your cash inflows present value total is 3,57,738. And then what is your cash outflow? 3,60,000, 3,60,000. How do you find out your NPV? Present value of cash inflow minus present value of cash outflow. So present value of cash inflow is this, present value of cash outflow is this. So your NPV is positive here at 15,000. Sorry, at 15%, it is plus 6490. At 16%, your NPV is minus 2262. You have to find out a rate at which your NPV is 0. So you can use the IRR formula which I had taught you, and by that you will get the answer as, by that you will get your answer as 15.74%. 15.74%. So your IRR is 15.74%. Have you all understood what is PVAF and also how do you find out IRR in this case? Let's move on to the next illustration. Can I get a yes quickly? Yes. Okay. What is the illustration that we just completed? It was, what is the number? The number was illustration number 8. So you have to go to illustration number 9 if I'm not wrong. Okay. Illustration number 9. So here they are saying an investment of 1,36,000 yields the following cash inflows. Okay. So here they are telling, if you are going to invest 1,36,000, here you are going to get all of these cash inflows. But what are these cash inflows? These cash inflows are profit before depreciation but after tax. Profit before depreciation but after tax. Okay. And they are telling, determine, this is the this profit is nothing but your earnings after tax. Okay. So here this determine MIRR considering 8% as cost of capital. So 8% is your cost of capital. MIRR reinvestment rate is what? MIRR assumes that the reinvestment rate is IRR or cost of capital. IRR or cost of capital. What does modified internal rate of return assume? Cost of capital. Very good. Okay. So here they have told you that in year 0, your cash flow is 1,30,000. Your cash outflow is 1 lakh. Cash outflow is 1,36,000. Okay, suppose if you are reinvesting it at 1 lakh, reinvesting it at 8%, which is your cost of capital, your cash inflows are your 1, 2, 3, 4, 5. These are your cash inflows. If you reinvest it at 8%, you find out the 8% factors here. Okay. Here, one thing that you have to remember is you will not do usually how you do 1 divided by 1.08. It will come as what? It will come as, for the first year, it is going to come as 0.9259 something. Okay, this is for first year, it will come as 0.9259. This is not what we have taken here. Why? Because when you reinvest, you have to remember the formula is cash inflow 30,000 plus, 1 minute. Formula is 30,000 plus 1 plus 0.08 to the power the number of years left that you can reinvest. 1, 2, 3, 4 to the power 4. This is how you find out. This is how you, this 1 plus 0.08 to the power is what is 1.3605. Okay, understood. Then if you multiply this with 30,000, or if you can directly do this 30,000 multiplied by 1 plus 0.08 to the power 4, you will get 40,815. The same way you will do for everything. Suppose for suppose for 30,000, what you will do? 30,000 bracket 1 plus 0.08. How much year can we reinvest it for? 1 year to the power 1, you will get this. Okay, see, 1 plus 0.08, 1.08. Okay, understood. Then you multiply it with 30,000 and you get your 32,400. So the same way for all the years, you will find out your reinvesting rate, and your total cash inflow at the end of 5th year will be 2,13,587. 2,13,587. Okay. So here the total return, how much it will be? 2,13,587 is your cash inflow. At the end of 5th year, your cash outflow. Your cash outflow is, 1 second. Yes. So your cash outflow here, rather than doing like this, I think we'll do by our method. Our method MIRR, how do we find out? MIRR, how do we find out? We do PV 1 plus R to the power N equal to future value. Future value is 2,13,587. Present value was how much? 1,36,000. 1 plus R we have to find out. Power N will be 5 years. So if you solve this, you will get R equal to, here as it is given, 9%. Here you will get R of 9%. Here you are going to get a R of 9%. So I hope you understand this. Okay, any doubts in this? Any doubts how you do this? I mean, regarding the sum now, how you, not how you solve this, but how you, how the sum went on. Modified IRR, will you be able to find out in the exam if given or if asked? How to do the root 5, or how do we, okay, to how do you do this root? No. So here what will happen? 1 plus R equal to 213,587 divided by 1,36,000 will come. Okay, 1 plus R to the power 5. Power 5 here it will be. Okay. So here you will get an answer. What is the answer that you get here? You get it as 1.5705 to the root 5. To the root 5 here you are getting, right? So here how you find out, either what you can do is go to my cost of capital video. In the cost of capital video, in the second part of my cost of capital video, which I've uploaded it on YouTube already, I have told you how to solve this. I've taken 10 minutes and told you how to solve this. Okay, you can go and watch that class, or else what I'll do is I'll give you the notes, and in that note it will be written how you find it out. Using that you can find out. Okay. Okay, yes, fine, good. Illustration number 10. So in illustration number 10, here you have two projects, project A and project B. The cash flow is given as below, project A and project B. You have to assume that the cost of capital is 10% and identify which a project should be accepted using NPV method and IRR method. I hope by now everybody knows this. NPV, how will you find out? You will take the cash inflows of project A, you will take the discounting factors at 10% and you will find out the present value. The same, you will take the cash inflows of project B, you will multiply it with the discounting factors and you will find out the present value of project B. Then you will do cash inflows minus cash outflows, and you will get your NPV in both the cases. I'm not explaining this again. IRR, how you will do? You have to take project A separately, project B separately, and find out. First, here what they have taken up here they have taken a 20% and 25% gap. They have taken one rate as 20% and another rate as 25%. Cash inflows of project A, they are first discounted at 20% and found it out. Then at 25%, they have again discounted and found out the cash inflows of project A. Okay, so by doing that for project A alone, I'll explain at 20%, 25% for project A. Stops working. Project A. The NPV here as you can see, the NPV is 6450 20%, 6450. At 25% is just minus 1120. So now you have to find out a rate at which the NPV is 0. So using the IRR formula, as you can see here, using the IRR formula here, you can find out the rate, which would be 24.26%. So it will fall between these both only. So it will fall between these both only. So it will be 24.26%. The same you will do for project B also. Any doubts in illustration number 10? Any doubts in illustration number 10? One thing that you have to remember is, if there is any question where they have given you two projects, then you have to, and they have told you to find out multiple things, then at the end you can put a summary and come. So overall position, project A, project B, NPV at 10%, how much it is, IRR, how much it is, okay, for both the project. So here they are telling you that you have to take a decision whether which project you should choose. So as per NPV, which project is better? As per NPV, which project is better? Project A or project B? NPV of project A is 25,000 something, project B is 59,000 something. So project B is better as per NPV. As per IRR, which project is better, project A or project B? Project A is better as per IRR. Okay, so here what happens? You cannot give a conclusion whether project A or project B is given. So in such case, you have to give that there is a contradiction in ranking by the two methods. Hence, we will not be able to provide a solution and we leave it at management's discretion. Let the company take the call. Okay. Yes. Next, illustration number 11. Illustration number 11, here you have two projects, project X and project Y. The cash flows are given as under. Okay. The cost of capital is 10%. Here you have to find out NPV and IRR. Same thing repeated again here. Do I need to explain this? First, you find out the NPV of both the projects that you know how to find out. You will discount it at 10% and find out. Then IRR, they are again taken at 20% and 25% they have taken. I think 20 and 25% was a gap for X project. Project X, one came as positive, one came as negative. But in case of project Y, in 20% also it came as negative. 25%, sorry, 20% also it came as negative. 1 minute. Okay. This alone I'll tell you, this bar alone I'll tell you, okay. Project X, they took 20%, they took 25%. 20% came positive, 14,950. 25,000 came negative, minus 400. So NPV must be here. So somewhere then they found out IRR was how much? They used the formula and found out IRR was 24.87%. This is clear, no? I hope Y X is clear. Y, they had a bar. At 20% they did, and they got minus 15,250. Now you tell me next factor whether they should choose as 25% or what they should choose. The same they should do here. Huh? What did I tell you? Higher the discounting factor, lower will be the value. So it will go in more minus only. Positive will not come. We need a positive NPV and a negative NPV to find out IRR. So here what will you do? If you were there in the exam, which discounting factor would you have used for project Y to find out a positive NPV? Which factor would you have used? I asked, I'll repeat the question again. Project Y, project X, what happened? 20% you got a positive NPV. 25% you got a negative NPV. Work was done there. No issues. In project Y, in 20% itself, you got a negative NPV. Now you need a positive NPV. So now to get a positive NPV, what factor will you consider here if you were in the examination? 15% you will consider. Very good. 15% you will consider. Anything less than 20% you have to consider. 15% you can consider. So they have also considered 15% here, and here they have got a positive NPV of plus 16,500. They have gotten a positive NPV here of plus 16,500. Now they will find out the IRR. Okay. So that sum is also done. Illustration number 12. I think there are totally 14 illustrations only. So illustration number 12 we are in. Illustration 12. Okay. Illustration 12. Illustration 12 also same thing. Project A, project B both has a equal life of 4 years and 4 years. Both have a equal life of 4 years and 4 years. So project A, this is the cash flows. Project B, this is the cash flow. Again, you have to find out NPV method and IRR method, and the 12% is the cost of capital. Do I need to explain this? We have already done two sums in the same way. Same, similar sum. Do I need to explain again? Can I move on? Will you all be able to do this? At least if I get a 10 replies, then I'll be able to be like, okay, fine. I've got 3. Quick. 4, 5, 6, 7, 8. 1 minute. No, ma'am. Why have they taken 50 and 15%? Go to next. Okay. Okay, here you're asking. Okay, first I'll tell you. Okay, this. Okay. Okay. I'll explain this. So here what have happened, I'll only talk about the IRR. Okay. Here, just a second, 50%, 15%. Okay. Okay, fine. This sum also I'll explain. I think you might get a little bit of a doubt here. NPV you will calculate. NPV is easy. IRR I'll explain. Okay. So let me explain IRR. Okay. So let us take project A. Project A, first you have found out that at 12%, not at 12%, present value. Okay. At 12%, it was 1,69,750, which is very, very, very far away from zero, which is very, very, very far away from zero. Okay. Now, if you have to bring zero, that means if you have to reduce your NPV or if you have to reduce your value, what you will do? What you will do? Increase your discounting factor. Very good. Now here, since the difference is so huge, I hope you remember in the last class itself I told you, if the difference is so huge that it's 1,69,750, then it will take a lot of discounting factors to come here. So they have taken a huge discounting factor gap of 50%. At 50%, they have got a discounting factor, they have got a cash discounting factor, they've got an NPV of how much here? 250 rupees. 250 rupees positive again. So now they have to again okay, fine. Okay. So here now what they have assumed, in this sum in this question, they have assumed that either what you can do is you can go for more further 55%. If you take, you will be able to arrive at a, if you take 50, now usually what we would have done, we would have taken 1 minute. We would have taken, we would have taken 55% and we would have got a negative value because the value keeps on reducing as the rates go on increasing, and we would have found out the IRR. We would have found out the IRR. This is what we would have done. Okay, this is what we would have done. Okay, but here in this question, they have not done that. If you see in this question, they have not done that. They have not taken 55% and found out. Now the question is why? Why have they not done it? Here the thing is that because they have assumed that 250, since it is so close to zero, 250 since it is so close to zero, your discounting, your IRR must be somewhere around 50.04% or 50.10% or something like that. Very nearby only your IRR will also come. So here they have assumed, then why should we waste time on calculating IRR? They have given that the approximate IRR will be 50% itself. So if you come down and see here, they have given that your approximate IRR is 50% itself. Understood? That's the reason for project A. Now let's take the case of project B. In your exam, it's better you do 50%, 55% and then find out the IRR and give them. Don't do this in the examination until this is the same exact question they have asked. Okay, project B. 12% was 3,36,400. They have taken 50% because the gap is too huge and they have got a negative value of 70,600. Okay. Either here what you can do using this 12% and 15% itself, you can find out IRR because you already have a positive NPV and here you have a negative NPV. In the question they have again taken at 15%. They have found out that the NPV here is 2,85,800. 50% it is minus 17,600. And they have found out the NPV. Either way, if you do 12% and 15% or 50% also, you'll get the same IRR only. If you do 15% and 50% also, you'll get the same this thing only. So it's up to your discretion what you want to do. And they have found out that 43.07% is their IRR. Okay, now somebody has asked me in the comment box that, ma'am, how can we take rates? Because in some question they haven't given any rates. Always start your in exam, whatever question is coming, start with 10%. If your value, whatever you are getting is below 50,000, okay, or somewhere around 50,000, then you go on with 15%, 20% and like that. If the value that you're getting is more than 50,000, like in this case, if you're getting suppose 3,36,000 or 2,85,000, then directly hop on to 25. Then directly hop on to 25% and see. Okay, and see what you get here. Okay, so something like it's basically trial and error only, start with 10 or 20 this, if you're getting a huge variance from 0 or 10 itself, then do 20 and see. It's up to your discretion. The more sums you practice, the more judgment you'll be able to make about it. Okay. Illustration number 13. I think there is one more illustration and that's it. We are done with the class. I'm sorry for elongating it for so long, but I thought I'll complete it with this itself. Okay. So Shiva Limited planning its capital investment program for next year. It has 5 projects, all of which have a positive NPV at a cutoff rate of 15%. So at 15%, all the NPVs are positive here. Okay. So here but they are telling they are telling that they have a maximum budget only of 1,20,000. They can spend only maximum 1,20,000. Okay. So this is nothing but the concept of capital budgeting under capital rationing concept. Here you have to ration your budget into which projects you can invest it in. Okay. So here you are required to illustrate the returns from a package of projects within blah blah blah. Here the projects are independent of each other and divisible. Independent and divisible means if any project requires an independent of if any project requires a investment of 2 lakh, you can still invest 1 lakh only. Okay. So here they have done that only. They have taken all projects. They have written all the investments there in thousands. NPV is in thousands. They have then found out NPV per 1 rupee invested. They have done the ranking. The ranking is 5, 2, 3, 4, 1. Okay. So here, the ranking is 1, 2, 3, 4, and 5. So first you will invest in project T. Second you will invest in project B. First in project T, second in project T, third in project C, and fourth whatever is left in project B. Okay, so this is the total investment happening, 1,20,000, and the NPV that you are getting from this is 55,600. Okay, here in project number D, you require 30,000 of investment, but you only had 20,000 left in hand. So you proportionately, they have taken the NPV here. For 30,000, if you get an NPV of 11,200, for 20,000, how much NPV will you get? They have calculated it. That is 7,500, and they have taken this here. And that is how they have found out. So these are the 4 projects you are going to invest in. Any doubts in this? Can we wrap up the session, guys?
So yes, guys, that's it for this video. So in the next part number 3, I'll teach you all the remaining illustrations and also the book back questions, that is your practical problems. So stay tuned for it, and I hope if you like this video, you would like, share, and also subscribe to the channel, and also share it with your friends so they also get the maximum benefit out of it. See you in the next video, guys. Thank you.